And we're going to do it through a PowerPoint presentation. So hopefully this is working. Let me just get this going. So we're going to do Accounting 201, Chapter 5, Example 7. And this seems kind of silly because I thought I could save it the other way, but apparently I have to do it with you. So you get to hear me both times. So sorry about that, guys. Hey, everyone. So the first thing you need to do is determine the sales revenue for Faro Company. The formula for determining sales revenue is net sales plus sales return and allowances equals sales revenue. So if we have 134,000 in net sales plus 6,000 in sales returns and allowances, that's going to equal our sales revenue, which is 140,000. Step 2 is our sales return and allowances. We're going to follow the same formula as step 1, but with a few modifications. So now we're going to use sales revenue minus net sales equals sales returns and allowances. So if we have 95,800 in sales revenue minus 81,200 in net sales, that's going to give us sales returns and allowances of 14,600. Step 3 is going to be the cost of goods sold. So in order to figure out the missing cost of goods sold by Faro Company, we need to follow the formula net sales minus gross profit equals cost of goods sold. So if we have 134,000 in net sales minus 44,000 in gross profit, we're going to have $90,000 in cost of goods sold. Step 4 is gross profit. Taking the same steps from step 3 but rearranging them, we get net sales minus cost of goods sold equals gross profit. So 81,200 is the net sales minus 54,200 is the cost of goods sold equals our gross profit, which is 27,000. Step 5 is operating expenses. It's a new formula. We're going to take gross profit minus net income, and that's going to equal our operating expenses. So if we have 44,000 gross profit minus 16,600 net income, we equal operating expenses of 27,400. Step 6 is net income, which is the same formula as before, sort of. This time it's going to be gross profit, which you can find in step 4, minus operating expenses equals net income. So 27,000 gross profit minus 14,460 operating expense equals net income. That net income is going to be 12,540. So great job with part A. It should look like this. So as you can see, we have all the different boxes filled in. Hopefully your answers look like mine, and because mine are correct. So let's move on to part B. Part B is profit margin and gross profit rate. So profit margin is net income divided by net sales. So our profit margin is going to be 12,540 divided by 81,200, giving us a profit margin of 15.4%. For Faro profit margin, it's the same formula as before, which is profit margin equals net income divided by net sales. So profit margin equals 16,600 divided by 134,000. That gives us a profit margin of 12.4%. Step 9, Ivanhoe gross profit rate. This is a new formula, which is gross profit rate equals gross profit divided by net sales. Gross profit rate equals 27,000 divided by 81,200. That gives us a gross profit rate of 33.3%. Step 10, Faro gross profit rate. Same formula as before, but with Faro's numbers, it's going to be 44,000 divided by 134,000. So our gross profit rate is 32.8%. So if your answers look like mine, it should be this. 15.4% Profit margin for Ivanhoe, 12.4% for Faro. Gross profit rate of 33.3% and 32.8% for Faro Company. My recording audio isn't working on this part, but what I would give you as your final tip would be to make sure you round your answers correctly in order to have the right answer. So that's about it, guys. So hopefully this helps you and you can get everything you need done. So have a great day, you guys. Bye.